Canadian monetary policy specifically, but this is more general. So I have already gone over last week I went over, maybe it was last week, I don't even remember. I've already gone over like a bond example, so hopefully this isn't new to you guys, but we are going to group financial wealth into two categories in monetary theory. And there's, basically we're going to assume you can hold it in cash, or you're going to hold it in bonds, right? And so yeah, we've gone over what the definitions of money are, right? There's a reminder for you. And then bonds are going to represent sort of any other form of financial wealth. Like in reality, obviously there's more than just bonds, but think of bonds as being anything that's not money-based. So we've already seen like present value discounting. We've seen how basically the price of a bond is equal to the present value of its future cash flows, right? Discounted at the market rate of interest. And so that PV formula tells us that when the market interest rate goes up, the bond price goes down and vice versa, right? Which is an important relationship. So when interest rates go up, wealth goes down, generally speaking, right, and vice versa. Yeah, we've already gone over this. This is hopefully not new. So basically, the market rate of interest is sort of like, the market rate of interest is like this concept where like you imagine that people everywhere are sort of deciding on a rate of return they want to see on investments, and then only going out and buying those investments, right? We're going to see how it's obvious, like we think of it as being related to the supply of money, so we'll see exactly how we believe the interest rate is determined, right? But in terms of like people's demand for money, it's kind of dependent on a lot of things, right? So one of the things, right, is like bonds are not without risk, right? Like obviously, if we go back, right, you see there's like a fixed payment schedule that comes with a bond, right? But the person could go bankrupt and like default on the bond, we say, right? So there's things other than just the market rate of interest that are going to go into a bond price in practice, right? There's things like credit risk, liquidity preference. We'll talk about that in a second, but basically people want to be compensated even if there is no risk for just locking up their money in something that isn't liquid for a period of time. And so we think of the bond price as being a present value calculation, but it's important to remember that like in practice they take other risk factors into account, right? So we have this theory, monetary theory basically consists of thinking about how does money and borrowing money work, right? Where the interest rate can be thought of as the price of money, and then the quantity of money is like the supply, right? And so we imagine that firms and households want money. And remember, what is money, right? It's cash and, I mean, if you use like the M2 definition, for instance, right? It's cash and demand deposits, basically, right? So your debit card and your physical cash that you hold. And I think you can read more about these in the G book, but basically we assume that the demand for money from the side of firms and households comes from three sources, right? We assume that there's a transactional demand for money, right? Like, imagine an economy where there's only $19 in circulation, you couldn't buy something that's $20, right? So there's like, obviously that's probably in practice a small part of it, but there is like a logistical need for money to carry out transactions, right? There's a precautionary demand for money. So for instance, people will like put away money in a non-profit maximizing way because like, for instance, what if they need, maybe I'll get fired from my job, so maybe I want to put away like 6 months of savings just in cash, right, that I can use if I need it. So we assume that people have, that's what we call a precautionary demand for money, right, precautionary savings. And then speculative demand for money, this is sort of like your Forex traders or people, maybe even firms, right? This is foreign exchange traders essentially, right? So there's some people that will maybe try to exchange their currency for Canadian dollars in hopes that the relative value will increase and they can make a profit. So that's what we call speculative demand, right? Holding a currency because you think it's going to go up or down in the future. Is everybody with me so far? So I think, yeah, it goes into more detail in the G book, but the important thing is that these three things are assumed to be negatively related to the interest rate, right? We assume that when the interest rate is high, people's demand for money is lower, right? Because they want to put it into bonds. if the money you make from putting something into bonds goes up, people are gonna switch from money to bonds. Does that make sense? And vice versa. So basically, when interest rates go up, the demand for money goes down. When interest rates go down, the demand for money goes up. The demand for money is assumed to be positively related to real GDP, right? Because we assume that when real GDP goes up, that transactional demand for money increases, right? Again, like I said, I don't think, in my opinion, like from papers I've read, that's not really a huge part of it, but it is there. In practice, central banks basically print as much money as the economy needs to function. So that's not really a problem in today's society. But when real GDP goes up, the transactional demand will go up and the precautionary demand for money will go up. And then the demand for money is assumed to be positively related to the price level. So if prices go up, you need to hold more money. Like if like the real value of your precautionary savings is declining, then you're gonna put more money, right? If things are starting to cost more, you're like, oh, maybe I need to have like 10,000 instead of 5,000 put away, right? Does that make sense? So the price level going up is like sort of increasing the demand for money within an economy, right? From the transactional side and the precautionary side. Obviously, the speculative side is going to be more to do with the interest rates, we'll talk about in a second. But those are the three determinants of money demand. I think there's a question in the practice questions about that, but that's what I'm talking about. Are there any questions about these three? Anybody? So these are three important relationships to remember, right? Because they're going to tell us about curve shifts and things like that. So here's an example, a graphical example, right? We have the interest rate, and then the quantity of money, and then this is what we call our money demand curve. I think Dr. Gaten calls it LD in the G book, but MD, L is for liquidity, M is for money at the same time. So yeah, an increase in Y or P would shift us right? So people demand more money for any given interest rate. Yeah, anyway, if you want to, I can't obviously post these slides, but like if you want, feel free to like take pictures or like ask me after. I'm just technically not allowed to distribute them for some reason. Yeah, but this sums up the relationship. This is money demand, right? So we'll talk about how the central bank does this. I think maybe next tutorial, or maybe if I have time after this. But we assume that basically there's an authority that controls the money supply, and so it's going to be fixed, right? We'll talk about it in a bit, but basically the money supply is fixed, and then we have the money demand, which is downward sloping, and so that equilibrium determines what the equilibrium rate of interest and what the equilibrium money supply will be. Really the interesting thing, not the interesting thing, the thing we're talking about more so right now is money demand.
When can the money supply move?
Yeah, right. Well, so that's what monetary policy is. It's controlling this, it's increasing or decreasing the supply of money. So yes, in practice, the government is going to be moving this line around maybe to try to influence the interest rate. Or rather, they move the interest rate around. In Canada, this is actually a horizontal line, right? Not a vertical line, because we target the interest rate, which then, by intersecting with the money demand, determines what the money supply is. But we'll talk about that after. For now, we just assume the money supply is constant. So, this is where we get into money, the monetary market, the money market affecting the real economy, right? We'll talk about the two views about that in a second, but basically, in our model, there is a clear mechanism, if interest rates change, right? So you'll remember in practice, right, like we assume pretty much every component of aggregate expenditure is ultimately influenced by the interest rate. But in our model, we focus on two sort of like immediate effects, right? Can anybody tell me which two components of aggregate expenditure shift when we change the interest rate?
It's exports, synetics, and investment.
Exactly. So I think for now they're assuming that we're in a closed economy, so they start with investment, but that's it, right? We assume that if the interest rate goes up, investment and net exports shift down, and vice versa, right? If interest rates go down, net exports and investment shift up. And I think there'll be a graphical example later. So, in our model, right, I think it's gonna, okay, it's not a graphical example yet, but basically if we increase the money supply, right, that's gonna decrease the equilibrium interest rate, right? think of it as supply and demand, right? The interest rate is just the price and the quantity is just like the quantity produced, right? Quantity demanded or quantity supplied, right? If we put more money into the system, all else equal, people won't need to pay as much to borrow money, right? That's how it works. And then if people's demand increases, right, for the three reasons we saw, if one of the three determinants shifts this curve, then that will increase the equilibrium interest rate, right? It's pretty straightforward, right? So, basically you can think of investment, right? Like obviously if you remember sort of in earlier chapters of the course, right, we treat investment as a constant, but constant in this model just means it's not a function of y, right? You'll remember there's what we call ceteris paribus variables that do influence this. So this is like kind of, imagine that full curve, right? This is just like, instead of looking at the relationship between investment and GDP, which just gives us a straight line, we're looking at the relationship between investment and the interest rate, right? So this is us kind of saying, okay, maybe our way of graphically describing when the interest rate goes up, investment goes down is this. Does that make sense to everybody? It's like, it's not like an imaginary curve, but like, that's why now we're looking at investment as sort of like this function, right? Because we've swapped interest rate, we've swapped real income for interest rate. And we know that there is a relationship between investment and the interest rate, right? So basically, if we increase the supply of money, we assume that decreases the interest rate, and that will increase investment expenditure, right? And so that's really, like, that's what drives most of it, right? Like, that's what drives the effectiveness of monetary policy is what interest rate change, or how sensitive is investment expenditure to changes in the interest rate, right? And that determines how easy it is for them to affect the real economy by changing the supply of money, right? I don't know why this slide is organized like this, but you can see the small graphs on the right. We've seen this, right? For now, they're just talking about delta I, but it's the same, right? NX also shifts up, so the result is a shift up of the aggregate expenditure curve, which shifts aggregate demand to the right. Everybody should be pretty familiar with that by now. And so this is a summary. This is a closed economy summary. So if we had a closed economy, this is what the monetary transmission mechanism would be, right? Basically, if one of two things causes the interest rate to change, right? We have an excess supply of money, fall in the equilibrium interest rate, increase in desired investment expenditure, upward shift of the AD curve, rightward shift of the AD curve, right? So in the short run, what's going to happen if we change the money supply is prices and output are going to change, right? As we've seen before, the AD curve is going to shift to a new short run equilibrium. Prices and outputs will increase in the short run, right? Yeah, and this is the open economy one, right? So we know about the investment expenditure, and then if you have international trade, the interest rate is going to affect the price of your the foreign dollar price of your currency, or that doesn't make any sense. But it's going to affect the value of your currency relative to foreign currencies, which as we've seen will affect the demand for your exports, right? But it's the same effect. Really all you need to remember is it's an upward shift in the, well, not all you need to remember. You should remember that chain of events, right? Money supply changes the interest rate changes investment changes the aggregate demand curve. That's the monetary transmission mechanism, right? Yeah, I don't think this is that important, but like this is basically, if you put money into the equation, then basically we have another motivation for the AD curve, right? But yeah, don't worry about it too much. Okay, so this is the important part, right? The strength of I don't know why it's called the strength of monetary force, but this is like the effectiveness of monetary policy, right? So down here we have our full ADAS model with a long run equilibrium, right? So yeah, we talked about how, yes, the money supply will influence the aggregate demand curve, and it'll intersect at a new spot on our short run aggregate supply. But in the long run, right, we assume that factor prices will adjust and will be back at the same real output level, but just at a higher price level, right? And so that's what money neutrality is. Neutrality is referring to its effect on real output, right? So when we change the money supply, in the long run, does that actually have an effect on what our real GDP is, what our actual production level is? And so the classical dichotomy, right, is contrasting the monetary sector as being separate from the real sector, right? We change money that affects prices and output in the short run, but in the long run, prices readjust us back to the same level of output, right? So according to that theory, right, if you lower or raise the interest rate, it'll have a short-term effect, and then ultimately, right, it shouldn't really have an effect on the economy in the long run, according to the classical dichotomy. Is everybody clear on that? I think that's a pretty important concept in this chapter. So, but in practice, right, like, I mean, we do practice monetary theory, right? Like we do change the interest rate in the hopes of changing what real GDP is, right? We want to close output gaps with monetary policy. And so, if we can't really affect GDP, then like, why do they conduct monetary policy? Well, the answer is that it's a little more complicated than what the classical dichotomy suggests, right? In practice, we've seen, right, our model does show that an increase in interest rates will decrease investment expenditure. We have to think about what is investment expenditure, right? Our model sort of focuses on like one instant in time, but maybe a more complex model that sort of has multiple dates would reveal that investment expenditure is adding to your stock of capital, right? So if whatever amount you invest is added to your country's stock of capital for next year, right? And as we've seen, our potential GDP is determined by our labor, our capital, and our productivity, right? And so there's like a theory, right? Like, yeah, if you're decreasing investment, then in the long run, we're gonna have less capital than we otherwise would have. So from that view, it's like, yes, monetary policy does affect real GDP in the long run. But like, this course isn't really necessarily taking like a stance on this. I'm just sort of presenting an active debate in economics, right? Does monetary policy affect the economy in the long run? Is everybody with me on this slide here? Any questions about classical dichotomy? So let's talk specifically, right? I mean, I think this is just showing the relationship between GDP growth and inflation. Or sorry, GDP growth and money supply growth. So you can see, right? Let's think of what this graph would look like if money were neutral and if money were non-neutral, right? Basically what this graph is suggesting is that inflation generally is going up at almost the same rate as the money supply. So I mean, like if money were truly neutral, right, you'd expect this to be a 45-degree trend line, right? Because you'd expect the price level to increase exactly the same amount that you increase the money supply, right? But this line is not at 45 degrees, so it suggests that there is maybe evidence that like money can affect output in the long run, right? Because if we increase the money supply from, let's say, I don't know what this, I guess it's percentage, yeah, annual average growth rate, right? If the money supply grows by 20%, but then inflation only goes up by 12.5%, then real output has gone up, right? Like the real value of your money has increased. Does that make sense to everybody? So I guess this is just kind of empirical evidence that, yeah, it does seem like money is non-neutral in the long run. But again, this is just one graph, right? There's a big debate. The important thing from that, though, is to sort of like understand what we mean by money neutrality and money non-neutrality, right? That's really what you should take away from that. So, but there's no disagreement on whether or not money is neutral in the short run, really. Like, we understand that pretty well, and our model does predict that, right? So, let's consider sort of how effective it is, right? So we've considered, basically, I'm trying to find, I don't know why, okay. I guess it's not gonna put them on the same slide for me. So there's two views on the effectiveness of monetary policy in the short run specifically, right? So the effectiveness of monetary policy, meaning what change in interest rates is required to produce a given change in investment expenditure, right? Which is ultimately what their goal is when you're trying to do things like close the output gap and affect inflation. And so basically what we call a Keynesian perspective, that refers to an economist from the 20th century called John Maynard Keynes. Maybe you've heard of him elsewhere in the course. But basically a Keynesian perspective, or rather a monetarist perspective, is that in the short run, changes in the money supply have a large effect on investment expenditure. And that, it really depends, right? I don't think there's really any broad truth. It depends on sort of like the circumstances of any given country, really. It depends on like maybe if all of your investment projects are long-term, like let's say you're a company and you're like a venture capital company, right? And you've invested in like Uber, but you don't expect it to be profitable for 20 years. You're not really gonna care maybe about short-term changes in the money supply because you're locked into that no matter what, right? Really all that's gonna affect is sort of like, there's going to be like an implicit opportunity cost. Maybe if interest rates go up, you're gonna be like, oh, I could have gotten a better, less risky deal, but like that doesn't change the fact that like that investment expenditure is often like locked in years ahead of time, you know what I mean? And so maybe if your economy has a lot of opportunities which are long-term like that, then your changes in the interest rate aren't actually gonna have a huge effect on a given investment expenditure. So that's the monetarist perspective, right? Is that this curve is very shallow. So small changes in the money supply produce large changes in investment expenditure. A Keynesian perspective is sort of treating money as more neutral in the short run, right? A Keynesian perspective is saying that a change in the money supply doesn't really affect investment expenditure much. So sorry, this Keynesian perspective would maybe be the perspective you would want to adopt if your economy had like long-term investment opportunities, right? Short-term investment opportunities, maybe like they mature in a year and then you're rolling them over every year, would be extremely sensitive. So things like mortgage payments, right? Which in Canada, I mean in the US they have like 30-year fixed rate mortgages. In Canada, we really only fix them for like 2 and 5 years if I'm not mistaken. And so like you can see how an interest rate would very quickly in the economy increase mortgage payments for people and things like that, right? Whereas like, again, like a venture capitalist, depending on their source of funding, is like if you're a billionaire and you put $1 billion into something, you didn't have to borrow that money maybe. So like you're not super sensitive to the interest rate, or you're very forward looking. You're looking into the distant future. You're looking through short-term changes in the interest rate. So yeah, that's monetarist perspective, Keynesian perspective, right? And that's basically it for chapter 11. What time is this? I think I'm actually going to leave it there, and the rest of the time will be if you guys have any questions. Obviously, next week there's no tutorial. There's going to be no office hours next week, but I think the tutorial is like the first day back from reading week, if I'm not mistaken. So there will be a tutorial next week. I think it's right before the midterm, if I'm not mistaken. So yeah. I think then we'll do midterm review. Hopefully I'll do the last chapter that the midterm will cover too. So monetary theory or monetary policy in Canada will be next Thursday, but no office hours on Tuesday. I'm gonna be in the States, so send me a message on Canvas if you like have an urgent question or something. But yeah, I'll be here till 5 if you guys have any questions.